American middle market companies put on a strikingly strong performance in the second quarter of 2019. I'm Tom Stewart, the Executive Director of the National Center for the Middle Market at the Fisher College of Business at The Ohio State University. And I'm here to tell you the story of the second quarter middle market indicator. Overall, business has been very, very good. The 12-month period that ended in June 2019 was exceptional for middle market companies. Let's take a look at revenue first. Middle market companies' revenue grew on average 8.5% during those last 12 months. And more than 4 out of 10, or rather nearly 4 out of 10 of them grew more than 10%. This has been a tremendous run for middle market companies. 3 of the highest growth quarters we've seen have come in the last year, and that 8.5% is substantially higher than the 7% average that we've seen over the history of the middle market indicator. But it's not just a story of revenue, it's also a story of headcount. And if you take a look at the headcount and the staffing growth in the middle market, you also see very high numbers. A 6.4% increase over the last 12 months. This too is the 3rd highest number that we've seen in the history of the middle market, and it's way above the 4.3% historical average that we've seen for payroll growth. Now, it's really interesting. 3 out of 10 companies reported headcount increases of 10% or more. This growth comes at a time of near full employment in the U.S. economy, which means, as that middle market executives tell us, not surprisingly, that their single biggest talent challenge is talent retention. Why? Because if they want to hire somebody, they can't hire somebody from the unemployment line. They've got to poach somebody from some other company. But that means that their competitors are also seeking to poach from them. So their number one challenge in dealing with talent is to try to keep the people they have so they don't get poached away by people at other companies. Overall, the picture that we're seeing, whether it comes from revenue growth, headcount growth, or other measures of performance, shows that it's been a really sunny time for business in the U.S. middle market. But there's always a but. Middle market executives have a decidedly cloudier view of the future than they have of current performance. Every quarter, we ask executives what they would do if they had an extra dollar. Would they put it right to work, or would they put it aside in saving? That sentiment is usually somewhat conservative. The lowest put it aside number we've seen is 29%. 71% invest, 29% put it aside. But those numbers came in the last half of 2018. For this year and in this quarter, we've seen a big increase in caution, with 37% of companies saying that they'd put the money aside and 63% saying that they'd invest it right away. Now, that's not the only cautious note that middle market executives are striking. Our short-term index, which is a measure that combines the plus and minus predictions for sales, demand, and the business climate, has been trending down for the last year, with the biggest declines are in forecasts for the business climate, which is a softer number than sales forecasts, but for the last 2 quarters, we've seen a growing number of companies predict that their sales will soften in the 3 months ahead. There's a third cloud. Executive confidence in the economy, global, national, and local, is down from its peak in the last half of 2018. It's flat compared to last quarter, but confidence overall has been trending down. Not a lot, but unmistakably down. Confidence, as you know, is something leaders want to feel before they make major decisions about expanding into new markets, adding new plant or facilities, or hiring new people. Indeed, look again at that number that I described earlier, the 37% who'd say that they would put that extra dollar aside rather than invest it. You can do 2 things with an extra dollar, with that saved dollar. You can put it into a war chest that you might use for future investments, or you can put it into a rainy day fund in case there's bad economic weather ahead. For the last 2 years, we've seen these be more or less equal options. But in this quarter, for the first time in some time, we've seen the rainy day fund become the place where executives would most be likely to put an extra dollar. So what are we to make of this? While business has been terrific, a growing number of middle market executives are worried. So far, the negative feelings we've been seeing are just that, feelings. Feelings about diminished confidence, more caution, greater anxiety about the business climate. The positive signs have been more objective. We've been seeing higher revenue. We've been seeing increases in headcount. And we've been seeing overall stronger performance by middle market companies. Harder things. So far, sentiment has not affected action, but it easily could. The current expansion is the longest expansion in recorded U.S. economic history. How long can it continue? The bite of tariffs, political uncertainty, the warning sign flashed by the yield curve on the interest rates, any or all of these could cause companies to ease back, to dial back the actions that they're taking and put a damper on the growth that we've seen. For now, what we're seeing, however, is this, with a sentiment of uncertainty. How are we going to resolve it? We're just going to have to watch and wait and see. For the National Center for the Middle Market, I'm Tom Stewart.